Good afternoon, all. Steve Parisi here with IBC Global. Hope your day is off to a great start. We've got one of our favorite guests today, if I can talk during this afternoon. Elizabeth, how are you, my friend?
I am wonderful, Steve.
Good to
Good to
hear.
be here.
Oh, good to have you. Thanks so much for your time, as always. So today we've got a fun topic that I think, with your experience, some of the stories you've shared with me before, I'm going to enjoy learning about. Talking about cash value life insurance, taxes, MEC, tax history. I think this will be great for listeners, as the history behind life insurance with respect to taxes is important, and also gives a lot of insight with respect to where it might go. So should be fun.
Good. Yeah.
Yeah, definitely. Why don't we start? Because where taxes regarding the cash value really began, more awareness around it, I should say, is in 1988 with the MEC law, when that came into place. So prior to the MEC law, and why the MEC law came into place, the modified endowment contract, is what people would do is really use cash value life insurance products purely as an investment, no regard for the death benefit or minimal regard for the death benefit. Often a single pay policy. They just shove money into policies, have it grow tax deferred, and they could draw on that cash value tax free by doing so properly through withdrawals and loans. And what happened, and you may have some insight on this too, is 1988, IRS said no. Wall Street did have some influence on that, just from my reading, and the MEC law was introduced, which put limits with respect to when taxes will occur on the cash value of life insurance policies.
Right. So exactly. Now, that was the first year I was started practicing law. So my whole life, I've known the MEC rules, really. But if you think about it, what's important to understand is that the reason that we get this tax advantage around life insurance is it's perceived to be one of those really important things for families, right? It's a way to provide generationally and to pay debt at death and those kinds of things. So in 88, I mean, it's like everything else. If it becomes abusive, somebody is going to say enough, right? And that's really what happened in the 80s. And so the idea is for viewers, if life insurance really walks like life insurance, talks like life insurance, then it will be tax deferred, or in many cases, tax exempt, because the buildup in the policy, there is no tax at all. But if it doesn't walk like insurance, but it walks like an investment, then it's going to be taxed like an investment. So there are things like overfunding a policy that will cause it to be a MEC, a modified. So that's what that means, modified endowment contract. But there are other ways too that you can have a tax problem in a policy. So you can actually cause the policy to not have the benefits of the life insurance, tax scheme by, for instance, having too much control over the investments, or not having the investments diversified enough, or having the policy invest in the wrong things, because then the policy will also fail. So the idea is that, Congress is very happy to give this tax benefit to assets in life insurance, but it really has to be life insurance. It can't be a disguised investment.
Right. And when you say where the cash value is invested, you're speaking more to the variable products.
That's more variable product. So, a whole life policy, what's great, there are lots of things great about them, but one of the things that's great is it's simple. It's not, you don't have to worry about those rules, but it's, I was really more referring to kind of the waterfront, that this concept of it being an investment product plays out through all different types of insurance. And as long as you understand kind of what the rules say, then you're not going to get in trouble. There are a lot of people out there selling products or financial transactions and saying that it's life insurance. when it really isn't. My team talked to a group yesterday that has a strategy that I won't describe in public here, but I was not able to be on the call, and they came to tell me about it. And I said, well, that's a financial product. I mean, I think over time, the IRS will say that, those investors are investors, and that's really not life insurance. So that's something that's important. And I think kind of in that same vein, Steve, as you and I have discussed, the question is, why does Congress allow this, right? It's really the only tax shelter available. In the old days, in the 70s, there were tons of tax shelters. I mean, all kinds of them. And then those kind of loopholes have been closed over the years. And now really, retirement plans are tax advantaged, of course. Annuities are tax advantaged, but life insurance is unique in that if you do it correctly, when you take that cash out, there is no income tax consequence. Mm-hmm. And the reason is that there's a very strong public policy argument that this is in the best interest of families and communities.
Mm-hmm. Yeah, and I heard that many times. So why don't we do this? I can kind of walk through how I'll explain the cash value buildup, a cash value life insurance with a non-MEC, where that can be taxable compared to a MEC, specifically where that's taxable. And then with the recent change, the 7702 change, the MEC, a MEC still functions as a MEC, but the MEC limits have changed. How I like to explain the MEC law with a life insurance policy, where you mentioned boundaries earlier, is it's the rule of the game. If I'm playing a game of football, I've got the boundaries. And as long as I'm aware of what those boundaries are and I stay within them, I'll be okay and I can use it tax-free. Right. If I go out of bounds, especially with life insurance, I've got 30 days to reverse it with the company. If I don't, it's taxable and I cannot reverse it no matter what. So I just want to understand the rules and stay in bounds. This way I don't mess up.
Right. No, exactly right.
Gotcha. So starting with a non-MEC, how just when you look at a cash value life insurance product, and I'll stick to whole life because that's really my niche and what I know in and out, is with a life insurance policy, the cash value buildup is technically tax deferred. However, like you said, it's very easy to draw down tax-free if you do so properly. I can take withdrawals up to basis and then loans. As long as it does not lapse, I can still access it tax-free.
Exactly.
Now, and with non-MECs, one thing I do like to make clear, or just provide transparency around, is you can still run into a taxable event with a non-MEC policy. For example, if I cash it out, if I pay in, to use simple numbers, $100,000 total over any period of time, pretend my cash value is $200,000, it's appreciated to that, and I elect to cash it out, the gains will be taxable to the owner as ordinary income. Not capital gains, but income. So that's with a non-MEC policy. And the same is true if I have a policy, use the same example. I paid in $100,000. It's worth $200,000. So you withdraw up to $100K, and then you begin to loan out the rest, the other $100,000. But assume you loan out every penny, you leave nothing in there. If there's not enough cash value to cover that loan interest, and I don't pay the loan interest out of pocket, the policy will lapse. And if that occurs, I have to pay taxes on the gains, the additional $100,000, and any accrued loan interest as well. Back in the 80s, when universal life policies were issued with those high interest rate assumptions, they projected phenomenal income coming out. It didn't happen. A lot of people got into trouble with that down the road. There are lawsuits, all kind of things with non-MEC policies. So from an awareness perspective, it's good to know about that. It's easy to prevent, particularly with whole life, because it's a fixed asset. It kind of is what it is when it's set up. But it is good to have awareness on that. This way we don't run into an issue down the road. And it's one of those situations like, I didn't know that. Mm-hmm.
Right. No, it's very, very important. I think for people purchasing those contracts, the big picture is really clear, right? Is it an investment or is it really life insurance? I love your example of the boundaries. So, kind of like bowling, you know, with bumpers, you want to make sure you have bumpers. You don't want to have a gutter on either side. So, and I really think that that's the key in having a partner who is providing your insurance, because here's the thing, what you just said is so important, because you've got to measure it on a regular basis, right?
Correct.
For instance, isn't it true that you could, well, let me ask you this question, because I tend to be more familiar with variable contracts. So let me ask you about high cash value, whole life. Well, in the variable world, if I don't have an increasing death benefit policy and my cash gets too high and I don't force it out, I could accidentally have a MEC.
Same thing.
Yep. Is it the same in a whole life product?
Yeah, that's one of our first conversation where it kind of got me. I'm like, this person knows what she's talking about when you refer to it as a push out, or when I refer to it as a long-term MEC, where a lot of times people think the initial 7-pay test is it with the MEC clause, and that but it goes beyond that. When you mentioned that, I'm like, she knows more than what you would think. But that was going back almost over a year ago. But you're correct. To answer your question, an increasing death benefit what happens is every 7 years that MEC limit resets, and it will tend to gradually decrease every 7 years. An increasing death benefit can offset that, because what happens is the MEC limit is based on an individual's age. Gender plays a role, but it's really age and total death benefit. So on year 8, after the first 7 years, if you have a policy design where that death benefit is shooting up over time, what happens is when it resets, if you started at 1 million, but now you're at 2 million, your MEC limit may have been 100K per year, and it's still 100K, as opposed to a level death benefit. That's not the case, where if you're still overfunding it, you'll be forced to pay in a lesser amount, or some money will get pushed out, just
right.
Like you said.
It's interesting, Steve, because if you are, clients a lot of times will bring me a proposal, and they will want to, they'll just want a level a level death benefit, and they see value in that because in their mind, I don't want to pay for more insurance, et cetera, because they don't understand the correlation between, we need to not have this be a MEC. You're trying to put as much cash in as you can. But at some point, if you don't, we may have a situation where it's going to become a MEC if we aren't watching it carefully. And so that really was the thing. One of the many things I liked about you is, if you're buying one of these policies, you need to have an advisor who's there with you and watching those particular issues. Because what you don't want, you don't want to be in a situation where the company sends you a 1099 with a bunch of income. Mm-hmm. And I've had clients where that's happened to them. So
yeah. That's interesting. Well, it's interesting and it's not. It depends on the agent, the insurance carrier as well. The companies I prefer do a good job with MEC awareness, I'm going to call it. For example, I can count on one hand, maybe a little bit more, the occasions where our clients have accidentally triggered a MEC. They've gone over their MEC limit, but none of them have had a permanent MEC. So if you ever go over that,
heard it. Yeah. Heard it.
Yeah, and it really has to do with the insurance carrier's systems and the agent seeing it. You have to be on top of everything to know, okay, we triggered a MEC. Literally all they want is an email from the policyholder to us. We forward it to the carrier. They refund the difference and you're good. So right. It's very easy to prevent if you've got the awareness. Like how I look at it, if someone gets a 1099, it's neglect. That's how I would view it more than anything else. Mm-hmm.
Right. No, I had a huge carrier who messed up, and then they messed up 2 years in a row, a 1099. It's a very long story. But it was really, really surprising in, so
Yeah.
it's important. Those little things become important. But I think, the big question that people always ask me is, well, how long will this last? What happens if Congress says no more, free ride, no more tax-free, basis of this income inside these policies? So let's think about the mechanics, because the insurance companies file with the IRS. The IRS does know how much income each of these policies is generating. So step one, does the IRS know? Yeah, they absolutely do. There's just reporting, but no tax. So could they then on a dime say, you know what, we're going to tax the internal buildup or income inside of an insurance policy? And the answer is they could. The question is, would they? I don't have a crystal ball, but I can't see why they would do that. Now, there's lots of reasons. The insurance lobby is one of the strongest, most active, and well-funded in our country. So that's, no matter what you think about lobbying, it gives you some comfort. But also the public policy reasons for allowing this to happen, I think will remain strong. So I really don't see a situation on the horizon. And believe me, I've talked to people. There was a woman who started an insurance company in Bermuda, really amazing woman. And I asked her once why she moved to Bermuda and, did this. And she said, because I was with Treasury, I drafted legislation that would tax, income or, capital gain inside of a policy. And it was a resounding no in an administration that I thought would have been really open to that concept. And I realized, you know what, they're never going to do that. So if I can't beat them, I'll join them and I'll sell insurance. And I thought, okay. So, it could happen. It really could. But just remember too, public policy in our country is pretty against gotcha situations, at least now.
Yeah.
I would think that the worst case scenario would be future buildup or future income might be subject to tax. But honestly, I honestly don't foresee that as happening. But clients ask me that all the time.
Yeah, it comes up quite a bit just in my weird world of cash value life insurance, where when we design policies with minimum premiums, maximum PUA allocation, what that does is give a consumer the highest possible cash value day one and throughout the life of the policy, especially on a guaranteed basis. So from an agent's concern, we have heard, hey, if you keep doing that and becomes widespread, it could be taxed. And I see that and hear it. And it could be from my corporate background. When I say corporate, when I design policies for corporations, because you got the same argument there, it's like it's been going on forever. If we want to talk about widespread, the amount of money corporations just shovel into cash value products is ridiculous. I don't see it. And thanks for sharing that story you just did as well. There's another story you had shared before, and I was like, wow, when you worked with the individual, he thought this is like the time I forget what it was, drafted a proposal. They thought it was that the rules would be changed with respect to taxing cash value life insurance buildup. And it didn't happen. Like, all right, he was convinced it was going to happen. It didn't. And it's like, all right, I mean, I appreciated you sharing that story. I didn't articulate it that well, but I recall that.
It was the same woman.
It was okay.
The same woman. So, there is that concern, as inartful as this is, I always measure things with the pigs and hogs example, because that's such a a kind of a Southern thing to say, but it's really true. There are a lot of people doing very hoggish things with insurance, very hoggish, and it's not what you're doing, Steve, at all. So do I think they might shut down? And what I have seen is them really look at things like investor control and diversification, some of these other measures of, is this really an investment or is it really life insurance? So while putting additional cash into a policy might look like it's a little bit of an investment, and in some respects it is, absolutely, because it's there's no tax on what's sitting there in the policy. And by the way, in most states, it's protected from the claims of creditors, right? Here's the argument that I would make, and I haven't really gone to read the policy discussions on the Hill about this, but the benefit, if you think about public policy, right? If I become disabled, if I lose my job, if I've put a bunch of cash into that product, then the premium can be paid from that cash over time. So there is some downside protection to families that I think is a reason why the IRS wouldn't care that we're doing that. And as opposed to these really crazy financial transactions that people are doing with life insurance, I think in the variable space, that's where we have a lot more of, some exposure.
Got it. That makes sense. And the recent change that occurred with 7702, it took life insurance just from a cash value standpoint and MEC limits kind of a step backwards or a step closer to what the laws look like pre-MEC world, right? So before 1988 with the MEC laws there. With the life insurance policy, I'll explain this to you, and I kind of like your comments and thoughts, how you often interject like that, is when we design a policy, there's two limits I'll always explain that a consumer wants to be aware of. You've got the insurance company limits. Specifically, if you're going to pay $1 in, $1 can go toward insurance premium, which does not build cash value in the first year, or toward PUA, paid up additions, which is in cash value immediately.
Right.
So I want to know, what are the limits the insurance carrier offers, and then where I can play within the boundaries, maximize those. And then the second limit is the IRS, the MEC limit. So if someone wanted to pay in, I'm going to use $100,000, right? That could be annually, doesn't matter. If it's $100K per year, literally how we would design that is if an insurance carrier allowed a minimum premium of 10%, which you'll see among the larger mutuals, that'd be a $10,000 minimum. And then I can allocate $90,000 toward PUAs. I need a term rider to prevent a MEC, but it's approximately 10% premium, as low as I can go per the insurance company, and then 90% PUA. Any questions on that before I keep going?
Uh-uh.
Okay. So that's the insurance carrier's limits. And all companies have different limits for transparency there. But then you've got the IRS limits, which is the MEC limit. How do I prevent a policy from becoming a modified endowment contract and then having to deal with taxes on the cash value? Is the fun part is with respect to that MEC limit is you can set it wherever you want. Like the policyholder and the agent, we can customize that. And how you do it, I'll explain it like this. The IRS will look at an individual's age and death benefit really as the measuring stick to see, is this policy classified as a MEC in our eyes or a pure life insurance policy, and therefore you can access it tax-free.
Mm-hmm.
So that death benefit really is the key, and you can tell I'm a nerd here. So if you look at pre-7702, a 4% guaranteed rate, if you were to take a 50-year-old male, he would need about a $2 million death benefit, almost exact. That would give him a $100,000 MEC limit. If he was 40 years old, you would need about a $2.8 million death benefit to get a 100K MEC limit. So the younger you are, the more life insurance you needed for the same MEC limit. So when we work with someone that says, the death benefit, I have a concern long-term, but right now my interest is the cash value, Steve, we'll say, okay, how much do I want the ability to pay in? Not commitment, but ability. They say 100,000 insurance carrier limit. I can set it down at 10,000, 10%. with the major mutuals, and then we'll set the death benefit at the needed figure to give me that 100K MEC limit or whatever dollar figure to make sure we don't run into a long-term MEC or anything. That was a lot of info. Any questions, comments, just as I was spitting that out? Or that
No,
makes sense?
but I think, so what I would like to hear, and maybe your other listeners too. So very simply, what changed
Yes.
to 7702?
Yes. So I need less death benefit to acquire the same MEC limit.
Got it. Yeah.
So, yeah. And where that's huge is use the example of a 50-year-old male that if he wanted to pay 100 grand per year in, he would need $2 million in life insurance. Where now the guaranteed rates have adjusted with 7702. And the lower the guaranteed rate is, the higher the MEC limit is with that same death benefit. So now I call it the game. The game's really changed because all life insurance companies before I saw a 4% guaranteed rate. Now they're different. You can take one carrier, take Mass Mutual. They've so far declared 4 different guaranteed rates that are associated with different products. They have another one coming out. Guardian has 3. So I can take the same individual and with different products have a different MEC limit. And all that means is if I have so I can make sure I simplify this, going back to the first example, a $2 million death benefit based on the old rules of 4% guarantee gives me a 100K MEC limit. If I take out a 2% guaranteed product now I only need that a $1 million death benefit for the same $100,000 MEC limit. And where you can really work it if you wanted to pay a lot of money into a life insurance product is you're limited on how much life insurance you can acquire based on your income, age and income. So now that hasn't changed. So if I qualify for $5 million in total life insurance, and let's say a year ago, based on a 4% guarantee, that would give me a maximum of $200,000 in MEC space. Well, today I qualify for the same $5 million, but now I can pay up to $400,000 per year without triggering a MEC. So it's opened up where I can shovel more money into cash and really reap the cash benefit. So that's the big change, if that makes sense. I talked a lot there.
Yeah. Do you know why they did that?
Yeah, with respect to why, it was a lot of pressure on insurance carriers. They wanted to lower the guaranteed rates. So at that 4% guaranteed rate, with respect to where insurance companies can place their investments, safe areas, kind of like we've talked about before, if it's bonds. Right. To simplify, if an insurance carrier goes out in the marketplace and can find 1% easily and they struggle to find 3 or 4% and they have to guarantee you and I 4%, that's difficult for them. They're just, the vice grips are getting tighter and tighter. So what this change has allowed for the insurance carriers, they could reduce their guarantees. So if I'm concerned in a death benefit purchase, if I am spending $10,000 in premium just for a life insurance policy, with a 4% guaranteed rate, that might give me, call it, I'm going to use round numbers, $1 million in life insurance. Mm-hmm. If it's a 3% guarantee, that same premium, the insurance carrier now only has to guarantee $750. If it's a 2%, yep, they only have to guarantee $500. So it's a lower guarantee benefit, but then that impacts the MEC laws. So complicated stuff.
Well, but it's also an indication of how much power the insurance lobby has.
Yeah. Well, I had read, it was just a quick article when that change was just quietly slipped in to say, hey, this is going to occur with life insurance. Is that, I forget what the amount was. Over a 10-year period, the IRS had stated that, or felt they were going to lose $3.4 some billion just in revenue from people going to life insurance instead of other areas. And that was surprising. But yeah, that was interesting when I saw that. That was over a year ago.
Yeah, I mean, it's just, how difficult has it been for certain lobbyists to get certain things passed, and the insurance carriers, smart group of people looking down the road saying we need to be able to decrease our guarantees for contracts in the future because things look a little more shaky. So anyway, but it's all very interesting stuff.
It definitely is. The last bullet point I wanted to touch on with this, with respect to this, and I think everything, especially in your world, as attention to detail is extremely important, is just the importance of having everything in writing. And what I mean when I say that with respect to the MEC laws and such is kind of like what you touched on before, that long-term MEC, the push out and such, where I've seen people get into trouble with MECs. A story a couple of years back. Met an individual, he's a really nice guy. He had purchased a life insurance policy about 10 years ago. It was before I was in the business. And he had done everything exactly according to that original schedule. Right? He had designed with premium PUAs,
Right.
was paying in. He was told, and the illustration stated it would never MEC. Now he's in it 9 or 10 years. He has not really been in contact with his agent. He gets an in-force illustration stating your policy will MEC in year 18 if you continue on the same path. And he's like, what? Like everything my agent told me, it was on the insurance company's illustration that I wouldn't MEC. And this happens to a lot of people, and agents scratch their head. I used to scratch my head all the time. I still do with a lot of things. I'm like, what's going on here? So specifically what happened is with the MEC limit, you've got the initial 7-pay test, and it resets beginning year 8. You've got a new 7-pay test. Is that increasing death benefit? When he purchased his policy, the dividend rate with that company was something like 8%. Dividends have come down. When we reviewed it, it was 5% and change. So if I've got a lower dividend rate, I've got less cash value, but also what do I have less of? Death benefit.
Death benefit, yep.
Did not appreciate at the same pace. So what ended up happening is when that MEC limit reset, it came down, and by year 18, he's going to trip the wire, if you want to use that illustration.
Yeah.
So he has to scale back his payments if he does not want that to occur. So where I go to always having everything in writing, because it confuses people, and then I see fear spread because of it, is it's simple. It's simple, but it takes a lot of time and effort on an agent's part. You can stress test a policy based on the current dividend rates. I love doing this, but then you can look at a conservative dividend. You can look at guarantees to see, based on that death benefit appreciation and how long someone wants to pay into it, will you run into a MEC at any point in time? And make sure it's in writing. You see it on the company's software, the different tests and such, that it's validated, and you're not just hoping, because it's confusing. It takes a lot of time and effort to dig into it. And when we put policies in force, we look at that. And if it's not there, it's like, we got to check that, because what if it was you? But
right.
Yeah,
right. No,
that's my point.
Absolutely. And the thing that is really probably that in a future video, we should talk about all of the ways to use these products, because what's fun is not only designing it, but then fitting it into the broader family structure or the broader corporate structure or the broader bank, structure, because these tools are incredibly helpful, because if we start thinking about a situation with inflation and the possibility of a change in the tax rates, then having this kind of tool is incredibly important, I think. And then also asset protection. I mean, going back to public policy, there are certain policies that our country believes in still, and that is that there are certain types of things that deserve special protection. A homestead, cash value in life insurance, even death benefit in life insurance, if it's handled correctly, it goes to a beneficiary. Retirement plans, 529 plans. So, that is also a unique aspect of our legal system and our tax system, that there are these types of assets that really every family should have. You should think of building bulwarks and making, in essence, your little fortress as a family. And you don't have to do very complicated things. You just fill those buckets and And, slowly but surely you have some good asset protection and really good tax protection too.
Yeah, I like that. Thank you. Well, this was fun. I could talk about this all day. We do talk about it all day here, but I appreciate your time. As always, thank you so much, especially on a Friday afternoon, taking some time. I always do this. Anything else you wanted to add before I abruptly end? I don't mean to be rude.
No, that's
Okay.
okay. No,
Okay.
I think it was great. And thanks so much for having me on. Have a wonderful weekend.
You as well. Thanks so much, Elizabeth. Enjoy.
Bye.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.